Hello, my name is Christy Marina, and this is a case presentation on private placement, due diligence, term sheets, and related regulations for Dr. Shiroki and Finance 139. A private placement memorandum, also known as an offering memorandum, is most commonly used for companies in need of capital. It provides investors with information about mutual funds, stocks, bonds, financial statements, and detailed material information about the company. It details all of the terms of an investment, requirements of the investor, and proper disclaimers and disclosures related to the business or equity. Overall, a PPM's objective is to provide buyers with the information on the offering and protect the sellers from the liability associated with selling unregistered securities. A private placement contains several sections used to inform investors. A PPM must go far and beyond the generic level to specifically address the terms and risks of an investor's offering. For example, key disclosures should be used that provides cautionary language explaining the intent of the document and its limitations. Legal disclaimers are provided to help explain the specifics of how the private placement works. There is also a section on risk that helps investors to understand the general and specific risks that are associated with the business and how those risks will impact the value of the shares. A section on the use of proceeds provides key information for investors, detailing how their dollars will be used to leverage the company to future success. Also, there are charts that show how the business gets capital and the dilution of stock that capital raising will cause. Lastly, a term sheet details the specific terms of the investment, such as number of shares, offering price, commissions to be paid on raised capital, and the type of shares. Because a well-written PPM provides detailed information and disclosures relating to an investment, when supplying funds, it is vital to have written material that can potentially protect you from fraud claims. The PPM is primarily used by entrepreneurs so investors can assess risk involved when making an investment and make an informed decision. A private placement is also vital to raising capital and is the second most important document for entrepreneurs in comparison to a business plan. A private placement offering is an investment of securities in a non-public setting, mostly to a small number of chosen investors. A PPO generally means any type of shares issued by a company to raise capital and is considered to be the most cost-effective opportunity without going public through an initial public offering. The offerings do not need to be registered with the Securities Exchange Commission and is one of the most practical capital formation alternatives available to companies due to the tightening of funding requirements. A private placement offering has some advantages and disadvantages. The advantages of a PPO are reduced transactional and ongoing costs because of the exemption from federal and state registration and reporting requirements. They also enable a company to structure more complex and confidential transactions because of the small number of experienced investors involved. In addition, a private placement allows more rapid penetration into the capital market because of the lack of the SEC filing requirements. Since private placement offerings do not require the assistance of brokers and underwriters, they are considerably less expensive and time-consuming. Although there are many advantages, there are also some disadvantages with PPOs. Acceptable investors may be difficult to locate and may have limited funds to invest. Also, private placed securities may be sold well below their market value because they are purchased at a deep discount. Investors that take risk in purchasing the PPOs want compensation for assuming an illiquid position. Therefore, companies undertaking PPOs may have to relinquish more equity. Lastly, it can be difficult to arrange private placement offerings in multiple states. Generally speaking, due diligence refers to the care in which a person should take with regard to negotiations with another party prior to an agreement. With regards to finance, due diligence is an investigation of a potential investment and serves to confirm all material facts in regards to a sale. Due diligence sounds impressive, but essentially it is just an extension of common sense success factors such as doing your homework or thinking things through. There can be many reasons on why due diligence is conducted, but I am just going to list a few examples. First, it is a confirmation that the business is what it appears to be. Second, it allows a thorough investigation to reveal any potential deal killer defects in the target and avoidance of a bad business transaction. And lastly, a due diligence is conducted to gain information that will be useful for valuing assets, defining representations and warranties, and/or negotiating price concessions. A term sheet is a non-binding agreement that sets forth basic terms and conditions under which an investment will be made. It serves as a template to develop more detailed and specific legal documents. Once the parties involved reach an agreement on the details listed out in the term sheet, a contract that conforms to those details is created. The term sheet essentially is the groundwork for guaranteeing that the parties involved in a business transaction are in agreement on the major aspects of a deal, making no room for any misunderstandings. It also ensures that the expensive legal charges involved in the process of creating the contract are not obtained prematurely. A term sheet is prepared by venture capitalists. A term sheet has a variety of protective clauses for the venture capitalist that can in turn significantly reduce the valuation for the entrepreneur. So it is vital to have an experienced attorney negotiate a term sheet alongside the entrepreneur. Four common terms that are included in term sheets can be preferred stock, liquidation preferences, dividends, and/or reverse vesting. Although private offerings are not subject of registration statement filed with the SEC, private placements are done in reliance upon Sections 3 of the 1933 Act as construed or under Regulation D as promulgated by the SEC. Regulation D sets forth certain guidelines for compliance with the private offering exemption. Any registered representatives who are involved in the private placement process are expected to have a working familiarity with Regulation D. To qualify as a private placement, an offering by an issuer must meet either the requirements of Sections 3 or must follow the conditions set out under Regulation D. With due diligence, there is a growing demand for expertise in helping businesses cope with challenges associated with new regulatory frameworks in the United States and beyond. New laws and practices such as the Sarbanes-Oxley Act, the Patriot Act, and OECD-driven regulatory conventions require that businesses and international financial institutions alike to be sensitive to possible conflicts of interest, money laundering, terrorist financing, fraud, corruption, and corporate malfeasance. With new programs for corporate sanctions now emanating from financial institutions like the World Bank and regional development banks, the need for businesses and investors to control regulatory risk has never been more pressing. Diligence is positioned, especially in emerging markets and on behalf of international financial institutions and multinational corporations, to respond to the new regulatory push for greater accountability and transparency. And that is the end of my presentation. Thank you so much.